Welcome back to the channel, friends. Let's learn how to select a company for investing. Most retail investors start with the same question: which stock should I buy right now? And that's actually the wrong place to start with, because a stock does not move on its own. It moves inside a sector, that sector moves inside a market, and the market reacts to the global conditions. If you ignore the bigger picture, even a good stock can turn into a bad trade. Well, to better understand this, we need to learn the top-down approach. It is a structured way of analyzing the markets. So instead of selecting a company first to invest, you start with the global trends and then move down step by step until you reach to an individual stock. Well, this approach is widely used by mutual funds, pension funds, hedge funds, and institutional investors because it reduces the randomness and gives you a rationale to select a stock. So before we talk about sectors, markets, and stocks, we need to first understand the environment in which all of them operate. And this is what investors call the global macro view. Well, global macro simply means looking at the big economic forces that moves the market all at once. And you don't need an economics degree for this. So right now, for example, global markets are dealing with major theme, the repricing of technology and AI related stocks. In this month, global indices sold off sharply as investors begin questioning which business model can survive AI disruption. Software and IT stocks globally came under pressure while the capital moved towards defensive and infrastructure plays. Well, this tells us something important. Global risk appetite is becoming selective, not broad-based. So let's drill more on this topic. Well, global macro is not about predicting the numbers. It's about answering the four major questions. Is money becoming more expensive or cheaper? Is inflation rising or cooling? Is economic growth accelerating or slowing? Is world in a risk-taking or risk-avoiding mood? And professional investors ask these questions first because these factors affect every asset class: stocks, bonds, currencies, or commodities. So there are mainly 5 factors which can help you to understand the global macro view: interest rates, liquidity and fiscal policy, inflation, economic growth, exchange rates, and global risk sentiment. So let us understand all these in detail. Let's understand the interest rates, liquidity, and fiscal policy first. It helps to determine how easy or difficult it is to borrow in an economy. Central banks such as RBI, Federal Reserve, and the European Central Bank uses the monetary policy, mainly interest rate and liquidity measures, to manage inflation and influence economic activity. So when interest rate rises, borrowing becomes expensive, consumer spending and business investment slow down, stock valuations comes under pressure, especially in interest sensitive sectors like real estate, utility and high leveraged businesses. And on the other side, when interest rate falls, borrowing becomes cheaper, investment and expansion increases, and corporate earnings improve, often supports the higher stock price. Well, interest rate also affect the asset allocation. When interest rate rises, bonds become more attractive as compared to equities, which leads some investors to move money out of stocks. Central bank also influence the market through liquidity measures such as bond buying programs and quantitative easing. Well, during economic slowdowns, increasing liquidity encourages the borrowing and the investing and also helps to stabilize or lift the stock markets. The 2008 crisis is a real example, where aggressive rate cuts and liquidity support restored investors' confidence and helped to recover the markets. Alongside monetary policy, fiscal policy also plays an important role. Government actions such as taxation, public spending, and stimulus programs directly affect the demand and corporate profitability. Large stimulus packages or infrastructure spending can boost economic activity and benefit specific sectors like construction, capital goods, and manufacturing, which in turn supports the stock prices. And this is why rate cycles dominate the long-term market behavior. Now let's understand the second factor, which is inflation. It tells us whether the purchasing power is rising or falling. Inflation erodes purchasing power and can negatively impact the corporate profits. Higher inflation often leads to increased wages and input cost, which squeezes the profit margin. If inflation outpaces the productivity gains, it can stunt economic growth. When inflation exceeds expectations, it can trigger market corrections as investors worry about its impact on consumer spending. However, Moderate inflation generally indicates a healthy economy, boosting investors' confidence. Historically, periods of high inflations like 1974 resulted in market volatility. Central bank responses through the monetary policy can help stabilize the markets. Well, markets don't react to inflation itself. They react to how policy responds to inflation. Now let's understand the third factor, which is economic growth. It answers a simple question: are businesses and consumers expanding or contracting? GDP growth reflects the overall health of an economy and directly impacts the stock market. A growing economy tends to attract the higher corporate profits as businesses benefit from the increased demand. Conversely, economic contraction can reduce the profits and harm the market sentiments. Stock markets generally perform well during the period of strong GDP growth, but they also react to signs of economic slowdown. For instance, during the early stages of COVID-19 pandemic, the global economy shrank and stock markets declined sharply due to recession fears. Investors closely monitor the GDP data to gauge whether the economy will continue to expand or will face a slowdown. Market moves ahead of the data. So this factor is all about direction, not the precision. Now let's understand the fourth factor, which is exchange rates. They play a critical role in the global markets. Exchange rate fluctuations can largely impact the MNCs. A stronger domestic currency makes the exports more expensive, which potentially reduces the sales for the companies who rely on the exports. Conversely, a weaker currency can enhance the exports, which benefits the company with significant international revenue. For example, when Indian rupees weakens against the US dollar, Indian exporters such as IT services, pharmaceuticals, and metal companies often benefits because of their dollar revenues, which converts into higher rupees earnings. On the other hand, a stronger rupee can hurt the export oriented businesses but benefits the companies who rely on the imports, such as oil importers and capital goods manufacturers. RBI intervenes in the currency markets to manage the volatility. Therefore, they influence the sector performance and stock prices across the market. Because global trade and capital flows depends on the currencies, exchange rate directly impacts the market and sector performance, not just individual companies. Finally, let's understand the fifth factor, global risk sentiment, which includes investors' psychology. Global event often acts as shock amplifiers in the macro environment. Health crises such as COVID-19 pandemic can trigger sharp market declines as economic activity shuts down and consumer behavior changes. However, market often recovers as government introduces stimulus measures and business adapt. Natural disasters and climate-related events disrupt supply chains, damages the infrastructure and impacts the profitability. As a result, investors increasingly factor the environmental risk into valuations, penalizing vulnerable industries while favor those aligned with sustainability. Technological shifts also reshapes the market. Innovations such as artificial intelligence and renewable energy create new growth opportunities while disrupting the older business models. Entire sectors can rise or fall as capital reallocates towards the future ready industries. Well, this explains why sometimes good company falls and average company rises. So, all markets, sectors, and companies operate within the global macro environment. If the global macro environment is unfavorable, sector analysis becomes unreliable and stock selection becomes high risk. That is why, in the top down approach, global macro analysis always comes first. It sets the direction and pace of capital before narrowing down to sectors, markets, and individual stocks. Now, let us understand the market level view. Once global macro view tells us how the capital is behaving, the market view tells us actually where the capital is going. The market view is not about individual stocks. It's about reading the collective behavior of institutions, foreign investors, and domestic funds. Indices like Nifty and Sensex represents the aggregate confidence. If the index is healthy, sectors get the room to perform, stock selection becomes easier. But if the index is weak, even good sectors struggle. Stock specific analysis becomes risky. So in the market view, we need to observe what's the index trend. Trending upward, consolidating, or breaking down. Markets that are trending or consolidating constructively encourage selective risk taking, whereas markets which are breaking down force capital into defensive behavior. And this tells us whether to be aggressive, cautious, or selective. The second part of the market analysis is volatility. Volatility tells us how comfortable or uncomfortable the market feels, but it does not tell us the market direction. In India, this is commonly measured using India VIX. India VIX reflects the expected market volatility over the next 30 days, which is derived from the Nifty option prices. It does not predict whether the market will rise or fall, but it tells us how sharply they might move. Well, to keep this simple, keep the VIX in three broad zones: low VIX, moderate VIX, and high VIX. Low is generally considered below the 15, which means the market is calm. Moderate ranges between 15 to 25, which tells you the market is cautious. And high VIX is above 25, which tells you the market is uncomfortable. And that is why the volatility belongs to market analysis, not in the stock analysis. Low volatility means market is comfortable taking the risk. Rising volatility means market is questioning the leadership. And very high volatility means market is protecting the capital. So before selecting the sectors or the stocks, we first check how calm or nervous the market is. One important thing to remember: low VIX does not mean there's no risk, and high VIX does not mean the market will crash. Volatility measures the expectations of movement, not the outcome. And that's why we use the VIX for context, not the prediction. The third and the most important element in market analysis is capital flow. Let's understand who really moves the Indian stock market. The two real big players who can move the market in minutes are FIIs and DIIs. Think of them as two giant teams putting money in the stock market every single day. FIIs means foreign institutional investors. These are large foreign funds from US, Europe, Singapore, and other global markets. For example, global mutual funds, pension funds, hedge funds, and sovereign funds. And DII means domestic institutional investors. These are large Indian institutions like mutual funds, LIC, SBI, SDFC Life, insurance companies, and pension funds. Both FIIs and DIIs trades thousands of crores of rupees every day, and which is why their behavior matters more than the retail investors. When these institutions buy very aggressively, the stock market usually is strong. And when they sell heavily, the market usually comes under the pressure. But the real insight is not in one side acting alone. It's in how both of them behave together. And that's where the market level signals comes from. Now let's see how to check the FII and DII data on a daily basis. So this data is publicly available and released every day after the trading hours. And these are some of the best sources where you can track the data. Or you can just do the Google search writing FII DII data today. So you need to look at net buy and sell. If it is a positive number, that means the net buy is there and the money is coming in. But if it is the negative number, that means there is a net sell and the money is going out. That's it, no complexity. However, you might see something like this on a given day. Foreign institutional investors are the net sellers, but the domestic institutional investors are the net buyers. And this tells us something very important. Foreign money may be cautious, but domestic long term money is supporting the market. And this behavior tells us why the Indian market does not fall sharply even if the FIIs are selling, because the DIIs are balancing that. So here are the four combinations which is good for you to remember. When both of them buys, when one of them sells and the other is buying, and when both of them are selling. So in short, this will tell you like the market is bullish or sideways or breaking down. But remember, never judge the market based on just one single day data. Always look at weekly or monthly trends. FIIs are short term and reactive. They respond quickly to the global economic factors like US interest rates, currency fluctuations, and geopolitics. Whereas the DIIs are long term and stable. They invest regularly because of the SIP flows and long term mandates. In recent years, DIIs have become more structurally strong, and which is why Indian markets are more resilient than before. So, if you're a long term investor, if FII are selling and DII are buying, you can continue your SIPs. But if you're a short term trader, wait for sustained FIIs buying for the several sessions. And always combine this with Nifty trend, volatility means India VIX, and the price action. So the bottom line is FIA data is like reading the smart money footprint, and we don't predict the market with this data, but we use it to understand who is supporting the market and who is stepping aside. A very good recent example is what happened in India in early 2026. In this month, the market showed a clear leadership shift. Banking stocks, especially PSU banks, significantly outperformed the IT stocks. And the symbolic moment of this shift was when SBI overtook TCS market capitalization and becoming India's fourth largest listed company. Well, this change was not about just SBI alone or TCS alone. It reflected stronger confidence in domestic credit growth, improving balance sheets in PSU banks, and caution against globally IT exposed businesses. So, when leadership changes at the top of the index, it signals the market wide re rating and not a stock specific event. For years, IT stocks dominated index leadership. Now, banks and domestic sectors are taking up that position. And this tells us where the institutional money is going and which theme the market is rewarding. So, this insight comes before the sector or the stock selection. And that is why the market level analysis comes before the sector analysis or the stock analysis. Now, let's understand the sector view. Once we reach to the sector level, the question is no longer which stock is good, but the real question becomes which type of businesses are likely to get benefit from the current environments. And this is the foundation of the sector analysis. So, what is a sector? Sector is a group of companies that operates within the similar business conditions. For example, IT companies mostly earns in foreign currency and depends on global tech spending. Banks depends on credit growth, interest rates, and asset quality. And consumer companies depends on domestic demand and income growth. Each sector responds differently to the same macro environments. And that is why sector analysis is not optional, but it's essential. So when a broad economic factor changes, it rarely affects just one company, but it impacts the entire sector at once. Take an example. Changes in the interest rate influences the banks and the financial sector. Currency movements impacts the export-oriented businesses like IT sector, and infrastructure capital spending impacts the capital goods and construction. If you understand this, this will allow you to position yourself ahead of the crowd before the move, not after the move is over. Important factor is sectors are not a single entity. Each sector contains subsegments. For example, financial includes banks, insurance companies, asset managers. Healthcare includes hospitals, pharmaceuticals, and diagnostics. And energy includes oil and gas, power generation, and renewables. Sometimes the money flows only to one subsegment, ignoring the full sector. But if you treat the sector as one block, you miss these nuances. So let's link our top-down approach so far. So far we have answered two big questions, which links our top-down approach. The first was what is global environment? The second was how is the overall market behaving? And currently we are going through the sector analysis. So it's important for you to understand that markets do not reward all businesses equally. Even when the index is trending up, only few sectors lead. And that is why sector analysis is very important. Think of it this way. The index tells you if you should participate. Sectors tells you where to participate. So let me show you the heat map of various sectors within India. Now let's go slow and try to understand this. So this is a sector heat map of Indian market, wherein you see each block represents a sector. Green means relative strength, red means relative weakness. Notice something important here. Index may look stable, but the sector's leadership is not uniform. Banking and financials are holding up or leading, while other sectors like IT is clearly under pressure. And this is why the sector analysis matters. The market is not going up and down together, but it's rotating. Sector analysis is all about identifying the group of businesses that are benefiting from the same economic forces. So when the condition changes, the money rotates. from one sector to another. And this process is called sector rotation. So sector rotation is not random. It usually happens because macro conditions changes, market leadership shifts, and capital becomes more selective. And this is exactly what we saw in India last year and so far this year. India's domestic growth and improving balance sheets are supporting the banks, whereas the global uncertainty and AI disruption is pressurizing the IT stocks. So let's make this concrete. For many years, IT was the leader in the market. But in early 2026, the things are changing as we saw the events like SBI overtook the market capitalization of TCS and became the fourth largest listed entity in Indian stock market. And this did not happen because just one company did something extraordinary. It happened because the banking sector benefited from the credit growth and balance sheet repair, while IT faced the global uncertainty and margin pressure. So, a professional investor won't ask which stock will go up, they ask which sector has the wind at its back. And once the sector is identified, they narrow down to the specific companies, avoiding fighting weak sectors, and align portfolios with capital flows. And that is how they reduce the risk before picking any single stock. A very common mistake is buying a cheap stock inside a weak sector. Even good companies struggle when their sector is out of the favor, and sector analysis avoids you from being trapped. Now let's connect the dots. Global macro analysis tells us the environment, market view tells us the mood, sector analysis tells us the opportunity, and stock selections comes last. If the sector is misaligned, the stock has to fight with the market. But if the sector is strong, the stock automatically gets the support. Alright, so if you're still with me, that means you really want to learn, don't you? So now we arrive at the final step, which is company selection. Only after clearing all the high levels do we really earn the right to analyze the individual stocks. So at this stage, we are no longer searching for the ideas. Now we are filtering, and the distinction is critical. So by the time we reach to this step, the global environment is understood, the market mood is clear, and you have found the sector which is showing the leadership. So the stock you're going to pick from the sector you have selected is no longer fighting the market, but it is supported by it. Now think what we have already eliminated: weak macro environments, unstable market conditions, and underperforming sectors. Out of thousands of listed stocks, we are now looking at a small subset that already aligns with the broader cycle. And this is how the risk is reduced before company fundamentals are analyzed. So the company selection is not about predicting the price moves, but it's about identifying the execution leaders inside a favorable market. So at this stage, we focus on these four major factors: clean balance sheets, earning visibility, the business structure, and most important, the management quality. And because for this sector the environment is supportive, good companies are allowed to perform. Take a practical example. If we think the banking is a good sector, we don't buy every bank, right? But we look for banks with improving asset quality, sustainable credit growth, and disciplined risk management. Sector strength narrows the field, but company analysis chooses the best executor. Well, I know this process may feel slow or boring, but that's exactly why it works. You're not reacting to headlines, but you're aligning with how actually capital moves. And that's how professionals consistently narrow thousands of stocks into a focused watch list. So, when you apply a top down approach for investing, the macro analysis sets the environment, the markets analysis sets the tone, sector sets the opportunity, and company selection decides execution. And that is why stock picking comes last. Not because it's unimportant, but because everything else must support it. Now, to connect all the dots, let's take a live example to understand how this really works in the real market. Well, let me clarify, this is not a stock recommendation, but this is about understanding how the process works. So, from our earlier steps, we already know the global environment is selective, the Indian market is currently supported, and currently, in my view, the banking is a leading sector. So, instead of scanning the entire market, we will only focus on the banking stocks. But even within the banking, we don't buy every bank. We first narrow down the banking universe into PSU banks, private banks, and NBFCs. Because the cycle is driven by domestic credit growth, improving balance sheets, and policy stability. We only focus on the banks who are directly getting benefited from this environment. Now and only now do we really analyze the individual companies. So at this stage, we need to ask these few questions. Is the asset quality improving? Is credit growth sustainable? Is the balance sheet clean? Is earning visibilities reasonable? So before we dive into a specific stock, let us read this news, which is very essential for us to understand what's working in the current market. So as you can see, the PSU banks were boosted by the government's plan to consolidate them into four major government-backed banks. So this news already gives you a confidence that these four banks, SBI, PNB, BOB, and Canara Bank, are the major banks who are getting the government backing for the upcoming infrastructure projects in India. So ideally, my target would be to analyze these four banks, and depending on how you want to allocate your funds, you can choose one bank or all of these banks. So we are not choosing SBI because it's cheap or because the stock went up. It's because SBI sits at the intersection of three top-down filters: a leading sector, strong market support, and improving company-level execution. Now let's see where you can find more about the financials. Now there are various websites which can show you the data, and I'm just using one of them to show you the heat map first. So this is a quarterly heat map for the different sectors in our stock market. As you can clearly see, the ones in the green are the ones who are positive, and the ones who are in the red are negative. And as we identified through our top-down approach is the PSU banks. So if you click on PSU banks, so here we can see what are the returns of the PSU bank sector for a day, for a week, for a month, or for over a year. So as you can see, the PSU bank sector has almost given 60% return within a year. Now if you scroll down, you can see the graph starting from 2007. It's trending up and up. There are corrections, but overall it's been positive. And these are the banks within the sector. So we see SBI, Bank of Baroda, Union Bank, PNB, etc. So top four bank which are actually backed by the government for infrastructure projects. We can choose all of them, or we can dive into the financials of any of the bank. So if we choose SBI, so once you click on SBI, it will take you to the financials of SBI, where you can analyze various data, but we'll just focus on the four elements we discussed earlier, which is if the asset quality is improving, is the credit growth sustainable, if the balance sheet is clean, and are the earnings visibility reasonable. So for that purpose, you can click on the reports. So here you see a lot of authors who have published their report for buy, hold, or sell recommendations, and it's free. You can download the latest report from any of the author. You just have to click on the PDF button, and there you go. You have the snapshot of all the key metrics which you want to analyze the SBI bank. So let us first see the asset quality, which is improving over the years or not. So as you see under the asset quality and credit costs section, the gross NPA is non-performing assets. You may understand in this way: if the bank has given, let's say, loan to 1,000 people, and out of that, suppose 2% defaults and they do not pay back. So this is actually a default. So those loans will fall under the non-performing assets category. So as you see from the recent quarter updates, the gross NPA declined to around 1.6%. The net NPA fell below 0.4%, and the credit cost remained contained. So this tells me something very important. SBI is no longer fighting legacy stress, and it is operating from a cleaner base. Now the second element we see is the credit growth. And in this section, we can clearly see the credit growth guidance upgraded to 13 to 15%, reflecting sustained momentum across RAM segment. So RAM is retail, agriculture, MSMEs, and a recovery in the corporate credit. So management has guided for double-digit credit growth, which is backed by a strong loan pipeline. That matters because growth is not coming from one risky pocket, it's coming from the real economy. And this shows earning durability, not a one-off cycle. So the third factor, I check the balance sheet strength. So SBI today is well capitalized. Capital adequacy is above regulatory requirements. Provision coverage is strong and buffers are healthy. So this means SBI can grow without raising emergency capital, which reduces dilution risk. And finally, I ask, can earnings be reasonably visible? Not perfectly predictable, but visible. So SBI earnings are supported by steady net interest income, improving asset quality, controlled credit cost, and a diversified loan book, which you can clearly see from this table where you see the return on assets is increasing. The net profit compared to the previous quarter is huge. So it gives a clear good earning capability. And the management commentary also suggests margins are expected to stay broadly stable. This gives me confidence that earnings are not dependent on one time gains. And this is where execution quality shows up. So, putting it all together, this is why SBI works as a live top down example, not because it's a PSU, not because it went up, but because it passes all four filters. Even if timing is not perfect, the environment is working in its favor. Investors can either analyze the company fundamentals by themselves or use the structured research tools to support their decision making. The key point is not the tool, but it's the process. What we are trying to do is to check whether the company executes well in these favorable environments. For instance, you may refer to the valuation score, which is considered by calculating the various relevant factors, and this will help you to perform the analysis. Alright, so this is what the powerful investing looks like. We did not start with a stock name, we earned the right to look at a stock. And that is how the thousands of stocks become a manageable and focused watch list. So if you remember just one thing from this video, remember this. Don't start with a stock, start with top-down approach. And that is the essence of investing. I hope this session added some clarity to how the top-down approach actually works in the real markets. If you found this useful, tell me in the comments. And feel free to suggest me the topics which you would like me to cover next. Subscribe to the channel for more structured, practical insights to help you invest with clarity and confidence. Take care, and I will see you in the next one.